Hey guys, Ahmed's here. Look, markets are going to crash. It's inevitable. Tariffs, like the ones Trump slapped on China back in 2018, can send shockwaves through the system, sparking panic and uncertainty. But guess what? Every crisis, every dip, every bit of chaos in the market is a chance to make some serious money. Today, we're diving deep into history's biggest market crashes, from the panic of 1907 to the COVID crash of 2020. We'll break down exactly what happened, why it mattered, and most importantly, how smart investors profited from the chaos. Oh, and stick around to the end, because I've got something special for you, a killer deal from a company that's going to help you protect your hard-earned cash and data while you're busy building your empire. All right, let's rewind the clock back to 1907. Picture this, San Francisco, a city still rebuilding from a devastating earthquake. The ground's barely stopped shaking, and the financial world gets hit with another tremor, a full-blown banking panic. See, back then, there wasn't a Federal Reserve to swoop in and save the day. When a couple of big trust companies went belly up, it triggered a chain reaction. People panicked, yanking their money out of banks left and right. The stock market tanked, plunging nearly 50% in a matter of months. Now, most folks saw this crash coming and thought, this is it, the end of the world. They sold everything, locking in their losses and missing out on a golden opportunity. But you know what separates the wealthy from the rest? They zig when everyone else zags. The savvy investors, the ones who understood that markets are cyclical, saw this crash for what it was, a fire sale. They swooped in, buying up stocks at bargain basement prices. And guess what? Over the next 4 years, the market roared back to life, gaining a whopping 193%. Those who bought the dip, they were laughing all the way to the bank. This, my friends, is a prime example of why understanding history is crucial to building wealth. The same patterns repeat themselves over and over again. Panic leads to irrational selling, creating opportunities for those who keep a cool head and stick to their long-term plan. So, the next time you see the market tanking, remember 1907. Remember the earthquake, the panic, and the incredible gains that followed. Don't let fear dictate your financial decisions. Instead, use it as a chance to buy low and set yourself up for massive returns. Because remember, in the words of the legendary investor Warren Buffett, be fearful when others are greedy, and greedy when others are fearful. All right, let's fast forward to 1929. The Roaring Twenties are in full swing. Flappers, jazz, and a booming stock market have everyone feeling invincible. But beneath the surface, a ticking time bomb is about to explode: margin debt. See, back then, people were buying stocks with borrowed money like it was going out of style. They figured the good times would last forever, and hey, why not leverage up to make even more money? But when the market inevitably took a turn, it triggered a catastrophic chain reaction. Margin calls forced investors to sell their holdings at any price, sending the market into a freefall. The Dow Jones Industrial Average, which had peaked at over 380 points, crashed by a staggering 89%, bottoming out at a measly 41 points in 1932. The Great Depression had arrived, and it wasn't pretty. Millions lost their jobs, their homes, and their life savings. The recovery was slow and painful, taking over 2 decades for the market to fully recover. Now, what's the big takeaway from this painful chapter in financial history? Simple. Never ever invest with borrowed money. Leverage can amplify your gains in a bull market, but it can absolutely decimate your portfolio when things go south. The 1929 crash is a stark reminder that markets are cyclical. What goes up must come down, and when it does, you don't want to be caught on the wrong side of a margin call. So, before you even think about borrowing money to invest, ask yourself this: can I afford to lose it all? If the answer is anything other than a resounding yes, then walk away. Trust me, your future self will thank you. Remember, building wealth is a marathon, not a sprint. It's about making smart, calculated decisions and avoiding unnecessary risks. And borrowing money to chase quick returns, that's a recipe for disaster. Chapter 3. All right, let's jump ahead to 1987. The economy is humming, shoulder pads are in, and the stock market is on fire. But on October 19th, a day that will forever be etched in Wall Street history, the unthinkable happened: Black Monday. The Dow Jones Industrial Average, the benchmark for the US stock market, plunges by a record-breaking 22.6% in a single day. To put that in perspective, that's like losing more than a fifth of your entire portfolio overnight. Panic gripped the markets as investors, fearing a repeat of the 1929 crash, dumped their stocks en masse. Program trading, a newfangled computer-driven trading strategy at the time, exacerbated the sell-off, creating a perfect storm of fear and uncertainty. Now, imagine you're an investor who had poured their life savings into the market just before Black Monday. You wake up, check the news, and see your portfolio decimated. What do? Most people understandably panicked. They sold everything, locking in their losses and swearing off the stock market forever. But a select few, the ones who understood that markets are driven by fear and greed in the short term, held their nerve. They knew that while Black Monday was a terrifying event, it didn't change the fundamentals of the companies they had invested in. And guess what? They were right. The market rebounded quickly, and those who held on to their stocks were rewarded handsomely. In fact, over the next decade, the stock market experienced one of the most remarkable bull runs in history. The Dow Jones, which had closed at 1,738 points on Black Monday, soared to over 9,000 points by the end of the decade. The lesson here? Don't let fear dictate your investment decisions. Short-term market fluctuations are inevitable, but they shouldn't derail your long-term financial plan. Remember, time in the market beats timing the market. By staying invested even through periods of extreme volatility, you give yourself the opportunity to ride out the storm and come out stronger on the other side. Chapter 4. All right, let's bring things up to speed with the COVID-19 crash of 2020. The world watched in disbelief as a novel coronavirus brought global economies to their knees. Lockdowns, travel bans, and widespread uncertainty sent shockwaves through the financial markets. The Dow Jones Industrial Average, which had been flirting with record highs just weeks earlier, plummeted by a gut-wrenching 30% in a matter of days. It was the fastest bear market in history, eclipsing even the swift decline of 1929. Fear and panic were palpable as investors, bombarded with news of rising infection rates and economic shutdowns, dumped their stocks and fled to the perceived safety of cash. Businesses shuttered, unemployment soared, and the future looked bleak. But amidst the chaos, something remarkable happened. Governments and central banks around the world unleashed unprecedented levels of monetary and fiscal stimulus. The US Federal Reserve in particular injected trillions of dollars into the financial system, propping up markets and preventing a complete meltdown. Now I know what you're thinking, money printer go brah! And you're not wrong. The scale of the stimulus was staggering. But here's the thing, it worked. The stock market, fueled by a wave of liquidity and buoyed by hopes of a swift economic recovery, staged a remarkable comeback. In fact, the recovery was so swift and powerful that it left many investors scratching their heads. Those who had sold at the bottom, fearing the worst, missed out on one of the most explosive rallies in history. The Dow Jones, which had bottomed out at around 18,591 points in March 2020, soared past its pre-pandemic highs within months. The COVID-19 crash, while undoubtedly a traumatic event, served as a powerful reminder that markets are forward-looking. They don't wait for good news to be confirmed, they anticipate it. And in this case, the market anticipated a recovery even as the pandemic raged on. The lesson here, while it's impossible to predict the future, understanding how markets react to uncertainty and crisis can help you make more informed investment decisions. Don't let fear drive you to make rash decisions. Instead, stick to your long-term plan and remember that markets have a remarkable ability to recover from even the most challenging circumstances. Look, market crashes are like unexpected storms. They're scary, they're unpredictable, but they're also a natural part of the cycle. The key is to be prepared, not paralyzed. Remember those who panicked in 1907, 1929, 1987, and even 2020. They sold low, missed the rebound, and probably regretted it ever since. But you're smarter than that. You're learning from history, building a solid financial foundation, and staying informed. That's how you turn market chaos into your own personal money-making machine. Now, if you want to track your net worth like I do, check out this killer tool called WiseFi. It's like having a personal CFO in your pocket. And hey, while you're at it, sign up for my weekly newsletter. It's packed with insights and tips to help you navigate this wild world of finance. Want to track your net worth like I do? Check out WiseFi at wisify.com/Graham. And don't miss my weekly newsletter. It's your cheat sheet for this wild market. Visit grahamstephan.com/newsletter, smash subscribe, and remember, panic sells, patience pays.